guys, today we're going to talk about whether or not you're an ideal candidate for student loan refinancing. Stay tuned. Student loan refinancing is so sexy. I mean, it promises to slash your interest rates and save you thousands. Ooh, but what's the catch? Here's the catch. Student loan refinancing is really best for those with substantial financial security. So what makes up financial security? What is it that student loan companies are using to cherry pick their candidates? There are 4 major criteria student loan refinancing companies are looking at when deciding if you're a good candidate or not. The first is all about your income. They want it to be high and predictable. How high do they want your income to be? Essentially, the higher it is, the better off you are. The average income of someone refinancing through Earnest was over $130,000 a year. Refinancing companies also want to see predictable income. They want to know that you're going to continue to get paid that high amount. For your own sake, you also need to have predictable income because once you refinance, your loan acts like a private loan without as much flexibility as the federal loan. The second criteria is that you have a good to excellent credit score. The lowest score that most refinancing companies will go down to is 680. There are a couple that go down to 660, but for the most part, they're looking for scores over 700. And the better your score, the better your interest rate. The third criteria is that you have some assets. And assets don't necessarily mean owning a home. They're looking at your cash flow. So what do you have in savings? What do you have in checking? They also want to know what you have in other investment accounts like a 401k or an IRA. The more money you have in assets, the safer of an investment you are. Last criteria is that you're ready to pay off your debt. You shouldn't use student loan refinancing as a way to extend your term. So if you're in a 10-year repayment plan federally, you shouldn't use refinancing to extend it to a 15-year term. If you need a lower monthly payment, you're better off finding a different federal repayment plan because it has a lot more flexibility when it comes to unplanned financial problems. If, however, you have high-interest private student loans, refinancing could still be a good option for you if you can get a low enough interest rate. Because even by just lowering your interest rate, you could potentially lower your monthly payment and keep the same repayment term. So now that you know their criteria, are you an ideal candidate for refinancing? If you're still interested in refinancing, I'll link up some articles on repayable.org that are super useful when you're going through the refinancing process. If you're not quite sure if refinancing is for you, send me an email. I'm Jenny@repayable.org. If you guys enjoyed this video, please subscribe and we'll see you next week. Bye!